So whenever you log into your trading platform and you go into the option chain for whichever stock you want to trade, you're typically going to see two different kinds of expiration dates. You're going to have the weekly expiration dates and then also the monthly expiration dates. And so in this video, I'm going to break down the differences between weeklies and monthlies and discuss the pros and cons of selling each kind. And then finally, I'll talk about which one, weeklies or monthlies, that I prefer to sell in my own trading. But as always, before we fully dive in here, in case this is the first video of mine you've come across, my name is Scott Reese and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case you want to see more trading or investing content after watching this video, you can also find me on SKILLSHARE as well, where you can take my very in-depth classes on options trading or stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for SKILLSHARE using any of those links, you'll get a full 1-month free trial. And so with that being said, now we're going to jump on over to ThinkOrSwim and we'll get things started. Okay, here we are. And so the stock I'll be using to illustrate the differences between weekly contracts and monthly contracts is going to be Beyond Meat. I do like trading the stock a lot because generally speaking, it is very liquid. And also right now, as you can see down here with the implied volatility chart, we are seeing a very nice expansion of implied volatility. You can see that right there. And whenever implied volatility expands like this, you're also going to see an increase in the prices of the options on Beyond Meat. So naturally, as an option seller, you want to be looking for stocks with elevated levels of implied volatility, right? Because you want to find the stocks that have very expensive options. When you sell those options, you're going to make the biggest profits. So that's the main reason why I chose Beyond Meat here. This would definitely be a stock that I would be interested in selling options on. And so now let's go to the trade tab, and this is where the option chain resides. And like I was saying, whenever you go to the option chain in your platform, you're typically going to see two different kinds of expiration dates. Here in yellow, these are the weeklies, and then in gray, these are all the monthlies. And everything is sorted by the actual expiration date. Now you might notice in the far future, there are no weekly expiration dates yet, and that's because the weekly cycles typically do not get posted until only a few weeks away. Right? There's no point in having a weekly cycle way back here that expire in 1 or 2 years. These options are called weeklies for a reason. And so for comparison reasons, let's take a look at the November monthly expiration cycle. These options expire in 41 days. And then we'll also unfold the October 22nd expiration cycle. These are the weeklies, which expire in 13 days. And one side note, there is no weekly cycle that expires in 7 days because if you do want to sell options with only 1 week left to go, then you can just sell options in the October monthly cycle, right? These ones expire in only 6 days. So even though this is the monthly October expiration cycle, because it's expiring in only 6 days, this is basically going to act like a weekly option. But just to make the comparison a bit more clear and obvious, we're just going to stick with the actual designated weekly options that expire in 13 days. It's not that much different. Now there are two major differences that come with selling weekly options versus monthly options. The first of which has to do with the amount of risk that you're going to be taking on. So let's say I am bearish on Beyond Meat for whatever reason, and therefore I wanted to come in here and sell a 33 delta out of the money call option. And this corresponds to the 105 strike. And in doing so, by selling this one contract, I would collect about $175, just going right in between the bid and ask prices here. But perhaps before I send this order, maybe I should also consider selling the corresponding monthly contract. Now, the way you find the corresponding monthly contract is not by going to the same strike in the November cycle. You actually want to compare the deltas of the two contracts. So with the weekly, again, this contract has a 33 delta. So that means for the November cycle, the monthly cycle, we want to find a call option with as close to a 33 delta as possible. And so scrolling back down here again, that would be this one right here. This is the 110 strike call option, and it has a 35 delta, very close. And just for your awareness, why do we compare the deltas and not the actual strike prices? And that's because the delta is actually the risk on the position, right? As Beyond Meat moves around in price, the delta of the contracts you're trading, that's going to dictate how much the price of that contract is going to move with the actual stock. So for example, if Beyond Meat stock goes up in price by $1, the price of this call option is going to change by $35. That's what delta means. And same thing with this weekly contract. Again, if Beyond Meat stock goes up by $1, the price of this contract is going to change by $33, a very similar amount. The reason why the strikes are different between these two contracts is simply because the monthly contract has a lot more time baked in. So therefore, there's a greater chance that Beyond Meat could work its way up to 110 and not just 105 with the weekly contract. So great, now we have identified the weekly contract and the monthly contract that correspond to each other in terms of their risk profile, but the weekly contract is still going to be more risky. Specifically, selling this contract is going to be more risky. And why is that? It's because the gamma in this column here, the gamma for this contract is higher than the gamma for the monthly contract. Now, without going into too much technical detail, gamma, conceptually speaking, simply corresponds to the price sensitivity of the option as the stock price fluctuates. And so essentially, the higher the gamma, and you will always find higher gammas with options that expire sooner, right? Again, as you can see here, the higher the gamma, the more sensitive the price of this contract will be to a move in the stock price. And that basically has to do with the fact that gamma will actually change the value of delta as the stock price moves around. But again, I don't want to get too technical in this video, so just understand that gamma basically corresponds to price sensitivity of the option. So by selling this weekly option contract, if Beyond Meat moves against you, specifically if it climbs higher, you're going to lose money a lot more quickly on this contract, the weekly contract, than on the monthly contract. But that also means the opposite is true as well. So if Beyond Meat moves in your favor, if it goes down in price, you're going to make profits a lot more quickly on the weekly contract than on the monthly contract. But ultimately, because the gamma on the weekly contracts are always going to be greater, you are therefore going to have more risk on these kinds of options. But you will also be compensated for selling these contracts as well. Specifically, if you sell weekly options, then on average, as time moves forward, you will be collecting a lot more in credit than you would collect by selling the monthly contracts. Now, of course, because these weekly contracts expire in only 13 days, they're obviously going to have much smaller prices than the monthly contract, which expires in 41 days, but we still can compare the prices of these two call options. We simply have to convert their prices onto a daily time frame. And the way we do that is simply by taking their current prices and dividing them by the amount of days remaining in the expiration cycle. So for example, let's do the weekly option first, and I'll pull up the calculator here, and I'll move this down below. And so as I mentioned earlier, the fair price for this call option is about $175. And if there's only 13 days left to go, we just divide this number by 13, and that gives us $13.46. So again, all I'm doing here is analyzing the amount of premium I'm collecting on a daily time frame versus a 13-day time frame. So $13.46 for the weekly contract. Don't forget that number. Let's scroll down to the monthly now. And so I'll go ahead and clear the screen. And the fair price for this call option, the corresponding monthly contract, is about $407. Again, going right in between the bid and ask prices here. And we'll divide this number by 41. And the answer we get here is $9.93, just rounding up a little bit. So this here is substantially less than the daily premium you are collecting by selling the weekly contract. And that extra premium you are collecting by selling the weeklies, that is your compensation for taking on greater risk, for having that extra price sensitivity baked into the options that you're selling. And financial markets are very efficient in that way. The more risk you take on, the higher the potential reward will be. So ultimately here, what that means is if you're selling weekly contracts, you can basically sell 4 weekly contracts in 1 month, right? 4 weeks in a month. And if you do that, you should be collecting a lot more in total credit for that entire month than if you were to just sell 1 monthly contract. So that's the first major difference between weekly contracts and monthly contracts. The second one has to do with liquidity. And by liquidity, I'm referring to simply the level of trading activity between monthlies and weeklies. And to analyze this level of activity, you can look at the trading volume, which you can see up here in this column, and also the open interest. Right, the volume corresponds to how many contracts were traded in one single day. So today, as I'm recording this video, it is Saturday, and so all these numbers here in the volume column correspond to the number of these contracts that were sold yesterday during the Friday trading session. And then the open interest simply corresponds to the number of open contracts that currently exist in the market. So for example, when you sell an option, you are opening a new contract, and that number will get reflected in this column here. Now, what you'll find in regards to liquidity is that monthly contracts will almost always have better liquidity than the weekly contracts. Or in other words, you will see a lot more trading activity with the monthlies than with the weeklies. The volume will often be much greater, and also the open interest. And so as you can see here with this November cycle, the volume for most of these call options is in the hundreds. And same thing for the open interest, although there are definitely a few contracts here that are in the thousands. So these options are very, very heavily traded. And what that corresponds to is very tight bid-ask spreads. So when you are trading these options, you'll very likely get filled at good prices. And it's also going to be a lot easier to get in and out of your positions. And then by comparison, coming back up to the weekly contracts now, as you can see in the volume column, there's not a lot going on. Only 28 contracts of the 104 strike calls were traded in Friday's session yesterday. And the volume for most of these contracts is less than 100. Same thing for the open interest. Most of these numbers are less than 100. And therefore, you're often going to find wider bid-ask spreads, and that's going to make it a lot more difficult to get in and out of your positions at good prices. Now, I will also say that for very well-known stocks, very heavily traded companies like Apple, Google, Snapchat, Uber, etc., all the big name companies, generally speaking, the weekly options for those kinds of companies should still have very, very good liquidity. Right? For example, let's go to Apple real quick, AAPL. And here we go, same weekly expiration cycle in 13 days, and take a look at the volume and open interest on all these contracts. Everything's in the thousands. So again, for these kinds of very well-known stocks, there should be no issue with trading the weeklies or the monthlies. Everything's going to be very heavily traded. So then in these cases, it pretty much just boils down to your risk tolerance. Do you want to take on a higher risk and sell these weeklies and get compensated more on a daily premium basis? Or if you're like me and you're a bit more risk averse, then you want to sell the monthly contracts. And so there you go. My preference is to always sell the monthlies. One, because I do trade a lot of different stocks and they're not always very well-known stocks like Apple or Google. And therefore, it's simply a lot easier to stick with monthlies across the board because, as I said, generally speaking, the monthly contracts are always going to be a lot more liquid. And then number two, as I mentioned, I am a bit more of a conservative trader. I don't like taking on huge amounts of risk. Not that selling weeklies is super risky, but it is definitely more risky. And then also one more thing in regards to liquidity. I do often make a lot of adjustments to my positions by rolling down calls or rolling up puts, etc. So again, because monthly contracts are typically a lot more liquid, making those adjustments is a lot easier and also a lot faster because I pretty much know with certainty there's always going to be another trader out there willing to take the other side of my trade immediately. But with weekly contracts, given that the volume and the open interest is typically going to be a lot smaller, although it's not really the case with Apple here, then making trades or adjustments will likely be a lot slower, simply because there's a lot fewer people out there trading the same options as you, and you both need to agree on the same price to actually make a trade. And so with that being said, that's going to do it for this video. I hope you enjoyed it, and please let me know your thoughts or if you have questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my SKILLSHARE courses, links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.